So the average of those last three rallies that really only span about 24 years, so three big rally cycles, the average is 413%.
So you talk about the supply side. Are industrial users rating silver ETFs right now? Like looking back through the charts, SLV never saw sustained falling inventories, not even during major price corrections. But since 2021, it's actually down 40%. So what's happening here? What is the impact of the falling inventories going to be?
So here's the chart that I actually put together. I had this suspicion that industrial users were getting their silver somewhere. One of the sources I suspected, we can talk about that in a moment, is some of the futures markets. But silver ETFs hold a lot of physical silver. There's all kinds of debates about how much of that is really there, but we go on the assumption that it's there. Just looking at one silver ETF, the world's largest, SLV, it's $10 billion. Has about 400 million ounces of silver. And this is the oldest silver ETF. It's existed since 2006. And so this chart shows you, if you look at the first two polygons, these are in green. And what they show at the bottom is that the first polygon shows that the amount of silver held by the ETF grew from about 2008 to 2009. This was the global financial crisis, while the price of silver actually corrected pretty significantly. So that was interesting. Silver holdings grew within the ETF. Then you had this big price correction from 2011 till about 2013 in the silver price, and yet a small correction to start with. And over time, the silver holdings essentially moved sideways. They were flat. There was no big sell-off in the silver holdings. Fast forward to 2021, and you have essentially sideways moving silver price, but a peak in the silver holdings, which would have been early 2021, and then a gradual, consistent sell-off up until today in SLV holdings of silver. So my view is that you have large industrial users are buying silver ETFs, so ones that are backed by silver. They're going to the administrator and they're saying, I've got here, X number millions of units of this ETF. I'd like the silver. Here are my units. This is where I want it delivered. And so they're taking physical delivery of that silver. That's one way to access it. And you're essentially paying spot for it. And then I was also, wondering about what was happening in the futures markets. So there are the three major ones being the COMEX, the LBMA, and Shanghai. So this shows the COMEX. Well, 400 million ounces back in early 2021, currently somewhere around 270 million ounces. So that explains over 100 million ounces of silver coming out of the COMEX going somewhere. Then you've got the LBMA. This, to be fair, includes some of the silver ETF silver. In any case, about, say, 1.2-ish billion ounces, dropping down by about 400 million ounces currently to just about 800 million ounces. And then you've got Shanghai, 3 billion ounces, dropping down to about 1.5 billion ounces over the same time span. Interestingly, all three futures exchanges, the silver ETFs, same drop. And so my impression is that you have large silver consumers, mostly industrial consumers, are buying long futures contracts, waiting for them to expire and then taking delivery. You have them buying the silver ETFs, turning in their units in that ETF for physical silver. So interestingly enough,
makes sense.
It does to me. And interestingly enough, I'm not an expert in this area, but you kind of piece this together. There was a report by TD Bank that came out just about a week and a half or so ago, 2 weeks ago, and they had essentially the same conclusion. And I just saw that report about 3-4 days ago. And they're saying that, and my estimate, and it's nobody really knows for sure what above ground stocks are of silver. But based on the pace of this trend, unless it slows or reverses, and I'd be interesting to see if it does or not, but it's easy to follow. They felt, as do I, that we had about perhaps 12 to 24 months before these secondary, I call them secondary inventories, are drawn down and completely emptied. And at
Wow.
that point, you're going to have a big consumer who was, comfortable and used to using this method of getting some silver, holding a long contract that the exchange is going to tell them, sorry, no more silver left.
Mm.
We're going to have to pay you out in cash and fiat or something. And they're going to say, that's not good enough. I actually need the silver, not the cash. And we're going to hear about it. That's going to make headlines. They're going to scream. We're going to hear about it, and that could certainly be a trigger for some kind of a mania phase, because that's going to be a clear indication there is not enough silver out there. And we could be wrong. I could be wrong. TD could be wrong. Maybe there's more silver, privately held silver out there. I would not be surprised that under a scenario of higher prices, but I think considerably higher prices, $40, $50, you will have some people selling their silver back into the market, helping to alleviate, supply tightness. But
I'm
based on
having
demand, I just don't
I'm
see it.
having I'm having deja vu. I feel like I heard this story a few years ago with nickel.
Oh, yes, absolutely.
Am I right?
There was an issue. I'm trying to remember. There was an issue with some fund. They were,
A
I think,
Chinese buyer?
yeah, there were some fund. Yeah, it was highly leveraged in nickel, and there were traders who had I don't know if you could say forecasted, but they were positioned to benefit from this uh, issue that came up in the nickel market, and in order to save the market turned around and told those traders, "I'm sorry,
Yeah.
we're canceling your trades.
We're
You're
doing
out
a
of luck."
redo here.
Right, you're out of luck, and that's probably in court somewhere. But odds that they'll see fair treatment, I think, are pretty slim.
Amazing. All right. So I appreciate you sharing that. It's going to be interesting to see how that plays out. So Peter, the gold to silver ratio historical mean is around 50. Today the ratio sits significantly higher. It's close to 83-ish, I think. It's been around 90 for quite some time. All in all, it's historically elevated. Um, where do you see this ratio going? There's been a growth lag clearly with silver versus gold. Do you see that equalizing and then flipping at some point where silver then is growing faster?
So what we've noticed, typically, let's say over the last, say, 30, 40 years or so, is that when you get the gold silver ratio falling below 80, and then continuing to fall from that point, that sort of tends to be the indicator, the trigger point, that we are in a ongoing, sustained rally cycle for silver. And at that point, silver starts to do very well. It continues to outpace gains in gold, but not to be forgotten that in that kind of environment, actually, both metals do very well. So it doesn't mean that gold is not going to do well. It just means that silver does better. It outpaces gold. But as I say, in that kind of environment, below 80 and continuing to fall, both metals will do well. Silver will simply do better than gold and outpace its gains at that point, assuming the ratio continues to fall.
So there's been a lot of interesting discussion, from inventory to interest rates to supply problems, et cetera. I want to read you something that was stated by David Morgan of the Morgan Report for your analysis. David says, for the record, I will state that there will be another more frenzied scramble, which will carry silver prices to highs that will repair all the excess paper money creation, price suppression, supply deficit, and bearish sentiment over the past 2 decades. This will become known as the Great Silver Crisis. Do you agree with this analysis, and why?
I absolutely do. I think that David's a very smart guy. David's been around this sector for quite some time, knows it very well, and he's seen how silver has behaved multiple times in the past and what has triggered it. And I absolutely agree with that. I think that, anyone positioning themselves, again, there's no need to take sort of outsized risk, but anyone positioning themselves uh, stands to benefit from that kind of scenario playing out. I absolutely expect that to happen. When? Nobody knows. Odds
Right.
of it, it's a when, not if. That's
Okay.
basically it.
All right, so I'm hearing clearly now's the time that investors should position themselves in silver and silver equities. If there was a broader market pullback, wouldn't that smash down the equities? So should investors wait for that entry point, or is it more of a situation where the market sector is so small that by the time you think you can time it and get back in, that the larger players will have already done, there's not enough liquidity there to capture it, and you may not be able to get it.
I believe it's the latter, and it's hard to know at what point some kind of a broader market correction will come. It's also, I mean, I would think that you would see people, uh, sort of. Okay, so if silver and silver stocks were to sell off, you'd see that, I think, more than likely in a scenario where you'd have a more sudden broader stock sell-off, index sell-off. And so that would create sort of a panic kind of environment. We don't know that we'll get that. Even if we get it, we don't know when we'll get it. We don't know from what level. Broader stock markets could continue to run for, who knows, 3 months, 6 months, or longer before you get that kind of correction. Silver and silver stocks could be considerably higher at that point.
Right.
So that's the first thing. The correction, a correction in broader indices doesn't have to come as a sharp, quick correction. It could come as a very sort of long, drawn out, slow fall where you see this gradual sell-off where you're kind of, cooking the frog by slowly turning up the water temperature. It never jumps out because it doesn't feel the water getting hot enough fast enough, and it's too late.
Death by
So
a thousand cuts instead of like jumping off of a cliff, kind of a thing.
exactly. So in that kind of scenario, people don't feel the impetus to get out of the broader stocks, and you don't have precious metal stocks, silver stocks in particular, necessarily selling off with broad stocks, because the broad stocks could sell off very gradually and slowly. So by the time you're down, say, 20% or so, it could have taken a year and a half to happen in the broader indices,
Mm-hmm.
and silver and silver stocks could be much higher at that point. So that's very tricky. That's hard to, that's anyone's guess. If anything, I'd say it would make more sense to look at the sector, do your research, get your feet wet, start to perhaps decide what you want to allocate to, how much you want to allocate, and make sort of small, gradual commitments. You don't have to
Mm-hmm.
do it all at once. I don't recommend doing it all at once. In fact, in the book, I talk about that. I say you can do these tranches where you say, okay, I'm going to allocate, say, $3,000 to a given stock. Well, you can do that over a period of several months and allocate, say, $1,000 to start with. Watch it for a while and then decide when you're comfortable with that second tranche, for example, of another 1,000, and then do it over time. That's a way to mitigate some risk of paying too much upfront if the stock were to back off a little bit from your initial purchase.
So start taking some positions to secure that you do have positions, and then dollar cost average or
Exactly.
every so often, and maybe even keep some cash on the sidelines so that if there is a big pullback and they do snap down a little bit, that would be the time to buy the final tranche.
That's an ideal way to present the approach. Absolutely, I think that's a
Okay.
great way to summarize it.
All right, great. All right, so the Fed stopped raising interest rates in July of 2023. It's been 9 months already. Historically, Can you tell us how have the silver miners performed 9, 10, 11, 20, 24 months after the last Fed rate hike?
Absolutely. In fact, I was curious about that because I had seen a chart similar talking about gold. So I've not seen this chart anywhere else. I decided I was going to go ahead and try and create it myself and see what the last few bull cycles looked like in silver when the Fed cut rates. And it's very interesting that what you do get is a run up in the silver price that starts later than gold's run up in that rate cutting cycle. So it's typically about halfways down through that rate cutting cycle. We can see that in hindsight. And there's been some tremendous returns. I was surprised when I went and did and created the chart to see what it looked like. So that first phase, that first rate cutting cycle was back in sort of 2000, 2001. And then by about late 2001, silver really started to run. And by the time it had that first peak, it was up 487%.
That's
And
amazing.
it's tremendous. And then when we had this rate cutting cycle again that we had through the financial crisis, that started in, say, mid or so 2008. And then you had silver from forget what point it was at that point, probably around maybe 15 or so dollars. It had a tremendous run. It had 500% gain right up until 2011. Fantastic run up. And then early in 2020, when we had this, very, very quick rate cutting cycle due to the COVID pandemic by central banks. And then you had silver again in a huge rally up 25%. So the average of those last three rallies that really only span about 24 years, so three big rally cycles, the average is 413%. So if we haven't even started to see rates be cut yet. And silver's already at $28. So, I mean, if you just had the average of 4 times, even from its current level, or even from $25, you'd be looking at $100 silver.
That's amazing.
It'd be tremendous. So yeah, I mean, there's I think a lot to look forward to.
There really is. All right. So, Peter, can you name a silver miner whose shares aren't diluted and is poised for a sizable run when and if silver breaks out past $30 for those watching to consider, like just to get their feet wet?
Absolutely. So a couple of names that they'll find interesting. I like, and I'm going to give a couple of names that are US traded. A lot of them are traded in Canada, but and these are larger names. So one of them is Hecla, which I think a lot of people will recognize. It's a larger primary. It's the oldest, I think, continuously running US silver miner. So that is one that they may want to have a look at. And then another one that is actually a bit of, so what's interesting about Hecla, just for a moment, is that it's nicely diversified. They have operations in multiple jurisdictions, a lot of really nice high-grade silver mines. And then you have a company called Mag Silver, also US traded. Very interesting company. It's been around for quite some time, but a much newer comer to the space than Hecla, for example. But so Hecla, Mag's been around, say, 15 or so years, perhaps a little bit longer. They have truly what's an anomaly in Mexico. They have a very, very large, high-grade silver mine. These very rich veins, wide veins that are producing anywhere from around 350 to maybe 500 grams per ton silver. So that's really big, rich silver mine. These are great companies that when silver runs, they will do very well. And they're amongst, I'm going to say, sort of the maybe medium, sort of lower to medium risk type of companies because of their size, the fact that they're producing, their cash flowing and so on. These are great names for people to look at and to get their feet wet with.
Yeah, I appreciate you sharing that. So I want to shift over to one question about banks here. I read on your Twitter feed, Peter, that it was a post you shared about banks being what you said was a glaring risk right now. You wrote black swans are by definition unpredictable, but overextended banks are a glaring risk that we've become too complacent about. What issues are you specifically concerned about right now for the banks? And are these issues great enough of a concern that we should all have an elevated level of worry about keeping excessive dollars over what is needed for bill paying in the banks at this time?
So I think that the biggest risk to the banks right now is their commercial real estate exposure. We are in a new paradigm since COVID. People do not like, if they don't have to, many people do not like to have to go back into the office. They're comfortable working from home. It saves them time. It saves them a lot of expenses, energy, travel, clothing, food, you name it. So it just makes their lives simpler in many ways. And people, studies have shown on average, people are very productive working from home. So I don't expect that to change. I think that commercial real estate will continue to be quite challenged. A lot of banks have a lot of exposure to commercial real estate. I think that's the biggest issue for them. And so that's where I see a potential problem.
And
Really,
if I'm not mistaken, a significant amount, several billion dollars, or I should mean, I'm sorry, $1 trillion of loans are maturing in that space between now and through 2027 or 2026.
that's right. I've got to be honest, I don't know the stats,
Yeah.
but yes, that is true. And that's a big issue. And we don't have to think far to understand the problem of it, which is that when these come due, one, the properties are not as fully leased out as the owners would like. So that's a problem. And then second, when these mortgages come due, they're renewable at much higher rates.
Yeah.
So you've got two things working against you. A lot of that's going to end up defaulting. And so the banks are going to be left holding those bags. It won't be pretty. If some buildings have the ability to convert to residential, I think that the ones that can very likely are looking at doing that, but there are just certain buildings that don't allow for it. And so they will have no choice. They will have the toughest time.
So essentially, though, putting excess savings into non-bank hands to protect that capital, and then also by having some sound money, because let's be honest, if the banking situation unfolds the way you're describing and the way you're expecting it to, the Fed is going to have no choice but to somehow, whatever that looks like, come to the rescue. And that's likely very inflationary.
Oh, it's absolutely inflationary. There's no question about it. And, you know, uh, as much as I'm not necessarily a fan of, say, treasuries, for example, that would to me make more sense to own treasuries, let's say in a brokerage account versus keeping a higher balance in a regular account. So you own this asset outright that's very liquid, and sure, it can lose value due to inflation. It more than likely will lose value due to inflation, but you do have liquidity, and I think that's a better approach.
Yeah, I appreciate that. So before we wrap up here and I ask Peter our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single interview that we conduct. And when you subscribe, we want to give you a free gift. It is a report that we wrote based on an important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." The free gift is a must read for everyone on why we all need to own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive that free gift on us. If you've enjoyed the conversation with Peter as much as I have, would you please let him know? Hit the like and subscribe button and leave a comment below the video. Peter, in wrapping up our discussion, I have a final question for you. Over the next year, something like 30% of the entire U.S. debt pile is maturing. That's about $9 trillion. Plus, we have several trillion in deficits that's going to happen over the course of this year. So that's more than 10 trillion, 10, 12, whatever it is, that the Treasury needs to issue this year. China, Japan, Russia, Saudi Arabia, and others are all either buying less treasuries or none at all now. Who's going to buy all of this debt issuance, and how does it play out if foreign nations don't buy it?
So that's actually probably an easy question because the Fed, I believe, is the one who will have no choice but to buy a lot of that debt, and it will be issued. There will be no choice. You know, to think that if foreign typical or previously typical foreign buyers are not buying anymore, and you have this much debt to roll over the next year or so, $9 trillion. What is the appetite? It's just hard to imagine that, the foreigners have the appetite if they've demonstrated for perhaps 15 or 20 years now that they have less and less appetite. So there's an easy answer to it. The Fed will absolutely be the one to have to buy a lot of that debt. And the debt's being issued at much higher rates than it had been over the last few years, where the Fed kept rates near zero for how long, right after the great financial crisis. So even if rates come down, they're still a lot higher than they were prior to COVID, and it's just going to be a major challenge to not do anything other than absolutely monetizing that debt. That's the way it's likely to happen. So, I mean, if you think about it for different reasons, but the best analogy is the 1970s. And I think people with this first wave of inflation that we've had, they unfortunately think that, oh, it's a one and done. We had this big wave of inflation. It peaked at 9. We're at 3.5. It's a lot more manageable now. And I would suggest that they look back at the 1970s, and I have a chart that absolutely shows this in the book, and nobody knows for sure, but I think it's a good analogy for what we're likely to see this time around. And we had that first wave that started in the late 60s, ran up to sort of the early 70s. The Fed raised rates, and that corrected. Inflation came down, but it didn't come down to prior levels. It came down to, it bottomed at higher levels. And then you had another wave of inflation going up. And you had that happen 3 times during the 1970s. So I think what we've just been through is the very first wave. I don't know how many waves there will be, perhaps 2 more, perhaps more than 2 more. But I think you have to be prepared for it. And there's a big difference too, though, with the 1970s. In that decade, the US's debt to GDP ratio was 35%. Today, it's 120%. So Volcker had the leeway,
latitude,
exactly, to crank up rates tremendously to levels that people find unimaginable today, 18%, 20%. I am old enough to at least remember people talking about their parents having mortgages that were paying 20% on their mortgages. How likely is that to work today? I mean, I think it's pretty clear to everyone that's virtually or certainly an impossibility.
Although I will say this, recently, Jamie Dimon, the president of JP Morgan Bank, CEO, he came out and said that he can see interest rates at 8% or higher, which means on the 10-year, which means that would put mortgage rates well into double digits.
Exactly. Well, and I don't disagree, but what will that do to the economy? That's sort of right. What is the effect of that? And so you could try that for a while, but you're going to crash the economy. And then you'll have, I mean, honestly, I believe that would lead to some kind of a reset. Things are extended enough as they are. Today we're at 120% debt to GDP. Can you really realistically raise rates as enough to try to rein in inflation? I don't see it, and that's why I think that the Fed will have to find a way to let it run high for years and years, for sure.
It's likely why they stopped at 5.25.
Right.
So just to put a bow on this, if they monetize a significant amount of that debt this year and next year and the year after, what is that going to do to the metals, to silver specifically?
Well, let's start with gold. Gold, has we're hearing, people who were doubters for the longest time now, even large banks, investment banks, coming out with forecasts of $2,500, $3,000 gold becoming much more the norm. People, 15 years ago said, if you're crazy, if you're talking about $2,000, now you've got investment banks talking about 3,000. So, you know, at at current ratios, if you do something like, what would that be, 30, with I'm trying to figure out,
Uh,
if you had $3,000 gold, right, and even a 60 to 1, what are you looking at? $50 silver easily.
mhm.
I think I've got that right.
You're
$3,000
still,
gold is
yeah, you
60
do,
to
and you're
1.
still elevated over the historical mean of gold to silver.
Exactly. You're still elevated. You haven't had I don't think that $3,000 gold will limit you to $50 silver. You were
Right.
talking earlier about how things move towards the mean and then overshoot. And that's absolutely what I would see happen. If you had $3,000 gold, you'd probably be looking at more like $70 or $80 silver.
Yeah. Yeah. So, and since we're near the beginning of this cycle, inflationary specifically, but also in the metals, we're likely, in a more prolonged period where we'll see some volatility, but we'll see higher highs and higher lows in the metals as we go along, and as that gold to silver ratio comes down, et cetera. So as they monetize more and more and more, this doesn't look like it's going to be a short-term snap up, snap down kind of a scenario, but rather a more prolonged environment, just like the 70s was. Not to say it's going to roll out like the 70s, but that environment was more prolonged.
Absolutely,
Yeah.
exactly, and it was. I think that we're actually in a similar situation to the '70s, except that the '70s was under a much more sort of compressed time frame. If you could argue late '60s until 1980, so maybe 13 years, 14 years. I think that the current bull, and for different reasons, started in 2000, 2001, with the sort of the rise of China and its demand for commodities. I think that was the first half. I think this is a secular commodities bull market. I think that was the first half of it. We had this drawdown. Very smart guy, Jim Rogers, talks about how typically what you get in secular commodities bulls, you get this drawdown where they'll correct by about half in terms of price. And this was an extended correction. And again, in my view, that went from, say, 2012, 2013 until perhaps 2020, when COVID hit and then things started to pick back up again. And I think that was just the middle part of the secular bull. And we're now entering the second half of it.
Well, I really appreciate the deep dive into silver. I'm super excited to see where it goes. Peter, thank you for coming on to the Metals and Miners podcast, for being so generous with your time, your analysis, and ideas. It's been very good to spend this time with you. Will you tell the viewers any final thoughts that you want to share with those who are tuning in, where they can learn more about your work, and how they can connect with you?
Okay, well, thanks, Gary. Yeah, I mean, I've said it a few times that I think this is early days in this silver bull market. You have not missed the boat. It's still at the dock, but it's getting ready to sail. So do your research, look for ways to understand the market more. Um, Again, you don't have to take outsized risks. Some of the larger silver producers can return you more than 10 times in this kind of a market. So you have juniors that will do obviously even a multiple of that. They are obviously higher risk, but you don't need to necessarily go that route. But if you are interested, the best way is to spread across a number of names. And some will do very well, others will not. But usually the ones that do really, really well, I'm talking sometimes, as much as 50 baggers. Honestly, it's incredible. We've seen it in the past. We will see it again. And they tend to make up for the few losers really in the portfolio. Again, do your research, spread out across not necessary to take outsized risk. You can follow me through my newsletter, Silver Stock Investor. It's at silverstockinvestor.com. It's the only silver-focused investment newsletter that I'm aware of. I cover the whole market, everything from physical and ETFs to junior explorers. A great way to get familiar with the whole silver space, I feel, is the book. That's why I wrote it, to give you an introduction to silver. It's everything from the history of silver, macroeconomics, supply, demand, what makes silver move, and ultimately how to build a silver portfolio. You can find that on Amazon. It's in print, in Kindle, and in an audio version. And you can follow me. I'm active on Twitter at Peter_Krauth. I'm on LinkedIn as well. And be great to have more people follow the silver space. I believe it's a generational opportunity. It really is.
That's amazing. And so everybody, if you want to take part in a generational opportunity, follow Peter, get to know his work, understand the direction that he's trying to point everyone in, and jump on board, even if it's a little bit. I look forward to having you back on, Peter. Thank you for being here. Everybody else, thank you for watching.
Thanks very much, Gary.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and of course, all of the interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift.